Welcome to the Security Economics Podcast. This is your host, Peter Harrell. On April 2nd, President Trump announced his plans to impose the most sweeping new U.S. tariffs since 1930. The scale of these tariffs is enormous. If they're fully implemented, U.S. average tariff rates will rise from the low single digits prior to April 2nd to between 20 and 30% by April 9. Indeed, with revenue estimates of $500 billion or more per year, Trump's announcement is the largest U.S. tax increase of any kind in decades. As anyone with an IRA or 401k this weekend knows, markets really hated Trump's announcement, which triggered the largest stock market sell-off in years. On the other hand, President Trump argues that his tariffs will create leverage to close deals that offer better terms for U.S. companies overseas, and that they'll help address America's long-standing trade deficit. And Republicans argue that the tariff revenue can pay for some of the tax cuts that Congress is currently working on. In today's episode, CFR's Brad Setzer joins me to break down what Trump did, foreign countries might retaliate, and what the economic impacts of the tariffs will be. Brad and I recorded this episode on April 3rd, the day after Trump's announcement. On April 4, after Brad and I recorded this episode, a small Florida paper company brought the first lawsuit to challenge President Trump's authority to issue these kinds of tariffs. I have long thought that Trump's use of a 1977 emergency powers statute to impose almost all of the tariffs that he's imposed during his second term is legally dubious. And I'll be watching to see if the courts strike down much or all of what Trump announced on April 2nd. In fact, I plan to talk with one of the lawyers involved in that lawsuit in an upcoming episode that I'll be co-hosting with China Talks' Jordan Schneider. But for today, I hope you enjoy Brad Setzer talking about what the president just did and where we might be headed. Brad Setzer, it's great to have you back, particularly here the day after Liberation Day. We now have Trump's plans for his universal and his reciprocal tariffs and maybe some signals of plans on a whole bunch of other tariffs to come. I really appreciate you joining to discuss all of this, Brad.
Well, it's nice to chat about it, although at this point, it's hard not to be a bit depressed.
I'll come to that in a moment of what exactly happened and what is most depressing about it, and also if there are any silver linings from an economic perspective for this. Trump had obviously signaled Liberation Day for many weeks. There were lots of different ideas that were under discussion, frankly, right up until the last minute by all accounts. What we saw, in my view, is really quite sweeping. But let me ask you, Brett, what most surprised you about what we saw the president announced yesterday?
I think what was most surprising was the level of the tariffs on Southeast Asia and the vast sweep. It wasn't just tariffs on China, it wasn't just tariffs on the top 15 trade partners. It was, even non-existent and non-populated islands got their own tariff line. And just the level, 35, 34 for China, some numbers above 40 in Vietnam. These are really big numbers. And the messaging out of the White House over the weekend was, well, we're not going to be at the top of the range. We're going to be a little bit softer. We're going to back off just a bit. And so if backing off just a bit meant you went from a 70% tariff on China to a 35, that isn't really backing off.
I was quite surprised by the rates we saw and by the breadth of it. So what did we see? We saw the president come out with a 10% tariff on all imports from any country, with a couple of exceptions that we can get to on particular products. And then, Brad, as you say, we saw these reciprocal or quote unquote reciprocal tariffs at rates starting at that 10% universal tariff for a country like the UK and going all the way up to 40%. It certainly is a higher rate than I at least was expecting. I felt like it had been signaled previously. And it also, as you say, Brad, we'd gotten some indications beforehand that maybe only some countries would be targeted. But as we've all seen from the memes going around the internet of, penguins sitting in the Oval Office, clearly some of the small island states were getting targeted.
You got to feel well. Like it's a moderate bleep, bleep, bleep USDR to not catch the non-populated island. But the other thing that is in the end surprising, although maybe not shocking, is that they didn't actually do anything that would be reasonably called a reciprocal tariff. The tariff formula turns out to be the size of your bilateral trade surplus from the exporter's point of view, our deficit relative to total imports. So there is nothing about the calculation that relates the tariff to the actual level of tariffs that are imposed on U.S. exports, non-tariff barriers. It is a simple formula based on bilateral trade. So it's a bilateral trade deficit tariff, not a reciprocal tariff. If you've ever actually read the trade report the USTR puts out, it is written by American industry, and it is mostly about limits on investment and failure to protect offshored intellectual property. And it has almost nothing to do with the things that cause bilateral or global trade deficits. Yet that was presented. It was called a reciprocal tariff, yet the formula actually turns out to be utterly unrelated to any actual trade barriers. So,
Brad, that's a really interesting point. We'd actually seen the USTR issue its most recent national trade estimate the day before the reciprocal tariffs came out. And as you say, I read much of it, didn't read all of it. It's a very long document. It was the usual laundry list of objections the U.S. has to discriminatory taxes and regulatory burdens and, insufficient IP protections and all these kinds of things that we've talked about for many, many years. But then, as you say, the actual tariff rate seemed to be designed in some ways just to come up with a rate that would substantially reduce bilateral trade deficits. What do you think the goal of these reciprocal rates is? What is he trying to accomplish by setting the rates where they are?
look, I honestly think the goal is probably to get rid of bilateral trade deficits. I mean, at some point, you have to just go with what the president talks about. And that's what he talks about. A bilateral trade deficit is evidence that you're cheating. That's his view. So I think there's a reasonable probability this is designed to get rid of bilateral trade deficits. It is also clearly designed to generate a bit of revenue. If you're going to do a 10% universal tariff, including on countries where the U.S. has a bilateral surplus, you're not just going after the countries who run a surplus with us where we have a deficit. The unknown is whether there's some scope to negotiate some of these tariffs down. I'm sure the president will enjoy other countries coming to him and asking for a bit of relief. And my gut is there may be some wiggle, but it seems like the lowest he's willing to go is 10, unless you're Canada or Mexico. If that's the case, the room for negotiation is much reduced. And I'm not sure he's willing to go to 10 for a lot of countries. So the signal seems to be these are really designed to do what the president has been saying, which is to bring bilateral deficits down, largely by bringing trade down. And over time, basically creating a tariff wall so that those companies who want to sell in the U.S. need to produce in the U.S. Even things where a wealthy country like ours that has a comparative advantage in more advanced sectors wouldn't normally produce every good on its own. So even where there's sort of obvious gains from trade, the signal is that the U.S. doesn't care. I mean, why are we tariffing Sri Lanka and Bangladesh? The answer seems to be they run bilateral surpluses with the U.S.
It's a very interesting point you made, looking at the way they have structured these rates of a 10% universal tariff and then quote unquote reciprocal rates or discounted reciprocal rates. Let's not forget he's being generous and actually charging.
It could have been 70, could have been 90 on Vietnam.
Right.
Whenever.
Let's not forget that he's being generous with the discount in the reciprocal rate. But he does seem to be signaling if there's deal space, any deal space would be somewhere between 10 and whatever the discounted reciprocal rate is. He does not seem to be indicating that there's any deal space that would involve America having below 10% tariffs, or at least that's how I read this.
Well, we will see how USMCA compliant evolves, because there's a lot of pressure. If you look at the 232 on autos, USMCA compliant is a bridge to US content in auto parts. It's not supposed to be a permanent end state. But you could at least imagine that USMCA compliant is expanded to a couple of other countries that do special deals with the US, like the UK. But I agree, the main signal is like, hey, best you can hope for is 10.
Right, he brought up USMCA and USMCA compliant trade. We obviously didn't see Canada and Mexico as sort of the two notable outliers. Maybe them plus Russia would be the notable outliers yesterday in very different ways. Are there any winners from what we saw yesterday?
I mean, Canada has gotten whacked on the auto tariffs and on the aluminum tariffs. Mexico's getting whacked on the autos. And, autos are 4 or 5% of Mexico's GDP. So really, if you think of all U.S. non-petrol exports are 5% of U.S. GDP, The fact that Mexican auto exports alone are 5% of Mexico's GDP kind of gives you a sense of magnitudes. But that said, if this tariff structure sticks, the incentive is to produce goods other than auto, steel, and aluminum, goods that are not on the 232 list in either Mexico or Canada, because you can make sure that those goods from now on are USMCA compliant. So in that sense, Mexico and Canada were the relative winners. It was shocking to me, frankly, given that President Trump's been talking so much about how Canada should be the 51st state, how Canada doesn't work as a country, to quote the president. I mean, I disagree, but to quote the president, that then Canada is left off this list. I guess the Carney call went well.
Let me ask you on the economics. Let's posit for a moment that we don't see a bunch of quick deals. And let's also posit for a moment that we don't see successful litigation challenging these tariffs, and that these tariffs, at something approximating the rates we saw announced yesterday, remain in place for the duration of calendar year 2025. What do you think the economic impacts of that are going to be?
Look, if there are no downward adjustments, and if we go ahead with pharmaceutical tariffs, with semiconductor tariffs, I would be surprised if we don't have something close to a recession. It's easier to see a 1 quarter slowdown than a 2 quarter slowdown. But, the just pay it costs of the combined tariffs that have been announced and implemented or scheduled to be implemented over the next couple of weeks, clearly over 2 percentage points of GDP. That's a big tax hike. I mean, there just isn't enough capacity in factories in Mexico, in the US, to make up for all that we now import from Europe, from East Asia, from Southeast Asia, from Bangladesh and Sri Lanka, let alone some islands in the South Pacific. So there's no way to get around the tariffs in the short run. And the tariffs in some cases are quite big. So the only way to get around the tariffs is if people don't buy anything. And so what I kind of suspect is going to happen is either people continue to buy, they just feel like they have no choice, and their purchasing power goes down. They have less money to spend on other things, less money to spend going out. You're paying more for clothes, you're paying more for bananas, you're paying more for coffee, you're paying more for all the stuff we import, even the stuff we don't produce here. And so it's a big tax hike and you have less to spend on everything else. A 2 percentage point of GDP tax hike typically leads to a pretty big slowdown. And that's not Democratic economics or Republican economics. That's just standard. So that's effect one. Effect two, and we'll see whether this happens, but I would wonder whether you're going to go out and buy a car in the second quarter when you know that autos are in short supply, because the marginal supplier is going to be a German, a Japanese, a Korean import, which are going to be hit by a 25% tariff. And when another significant part of supply is hit by the tariff on the Mexican and Canadian content, so there's going to be tariffs on those that are going to push up their price. So unless you're confident that you're never going to see those tariffs taken off, you may wait. If you think these negotiations are real, you may be misleading yourselves. But if you think there's a big probability that you could see the price of a car, which has just gone up by, say, 10 or 15%, come back down by 10 or 15%, you may wait a bit. I mean, you don't have to purchase a car on any given day, typically, unless you've had a wreck or something. So I think you'll see some pullback in consumption. The uncertainty on investment, same thing. If you're going to build a semiconductor fab right now, you would have to import a lot of equipment from the Netherlands and Japan and elsewhere, and you're going to be paying high tariffs on that. U.S. steel prices for all the construction are going to be unusually high. Are you going to make that commitment unless you're 100% confident that there's a market for the chips, which may or may not be, and unless you're confident that there's not going to be some exemptions or exclusions or lower tariffs? So I think you're creating a little bit of a bullwhip effect. I think we'll see consumption pulled forward in the way imports have been pulled forward into Q1, and then a big dip in Q2. And then it just becomes what happens to momentum, because the underlying fact is we just raised taxes in a big way. We've done a big fiscal consolidation. There may be tax cuts down the line. You may see a cyclical pickup later in the year, but in the near term, pretty clear shock. And then over the long run, look, these aren't targeted tariffs. They're not designed to help the U.S. build up industries in strategic sectors. They are pretty universal, and if anything, a little weighted because of the emphasis on Southeast Asia towards consumption goods that are the low end of technical sophistication and where there's not likely to be, even with a 25% tariff or whatever, much substitution back to the U.S., nor would they be goods where you would say the U.S. should be producing. It's not chips. It's not permanent magnets that go into a range of clean energy applications and also fighter jet radars. This is not strategic. And so in that sense, I think in the long run, there's an efficiency loss without any gains, without any sense that you're playing catch up in sectors which are going to be the leading edge sectors in the next 10 years.
When I look at what Trump did during his first term with this trade war on China, he took a very different approach there. He actually excluded fully many of the kind of consumer goods that people buy from China, many electronics goods, things like that. And at the time, you just look back at the press, this was in part because he was aware of the inflationary effects, or at least his advisors were. Some articles at the time about advisors telling Trump, don't ruin Christmas. And that seemed to resonate.
That was called the Christmas tariff list.
Yeah, right, exactly. And this is just totally different because, as you say,
we're not doing it in October. So
yeah, that's true. So it won't literally ruin Christmas, it'll ruin all year. But to your point, Brad, the rates, the way these rates are structured, going after at very high levels some of the Southeast Asian, East Asian countries that produce a lot of consumer goods, it does seem to me that American consumers are going to feel this. What do you think is going to happen to inflation? And relatedly, one of the arguments we heard prior to yesterday was, well, the value of the dollar might go up, which will partially offset some of the price impacts of the tariffs. Doesn't seem to be what we have seen happen over the last 24 hours. So what do you think we're going to see on inflation and then kind of dollar value over the coming couple of months?
Look, it's a one-off increase in prices. Whether you want to call that inflation or not, I don't have religion. But in the common parlance, that's inflation. Probably 2 percentage points. Some estimates are 1.5, but I'd be a little higher than that. Pretty big. You'll notice it. Go into Walmart and you will feel it. You'll just feel like prices have gone up. Like during the pandemic when you bought a cup of coffee, you felt the increase in coffee prices. You felt the increase in lunch prices if you were in D.C. or New York. I think you're going to feel it when you go walk into a Walmart because of the de facto targeting of consumer goods. I don't think it was intended, but I think that's the effect. Then I think you'll see people will have less purchasing power. They will spend more on essential goods, more or less, and they'll be spending less on U.S.-made services. So then I think you'll see a fall off in the price pressure. This is very much what you see with an oil shock. This is like at least a $50 oil shock equivalent and maybe closer to $100 when you add everything up. It really depends on how much opportunity there is to substitute away. That's big. What you see then is all the effects of an oil shock. Big upward increase in prices, and then less purchasing power and no dynamic shifts in inflation. And then over time, we're a slightly less efficient country. In terms of the dollar clearly isn't going to help offset the best in theory there, not playing out. A lot of people got that one wrong. I think there were a couple of reasons why people got that wrong. One is that there was this overarching assumption that the tariff action wouldn't affect the attractiveness of U.S. financial assets. And I think what we've seen is that it is impacting the attractiveness of U.S. financial assets. If inflation goes up and the Fed's on hold, real yields on U.S. bonds go down. Now, you can debate whether nominal or real yields matter, but that's affecting perceptions. If U.S. stocks sell off, a lot of people were buying U.S. stocks abroad. So that's less demand for U.S. financial assets. And then between the U.S. is supplying fewer dollars because we're spending less on imports effect, and the U.S. economy is slowing and people are expecting that the Fed will have to take actions to offset the slowdown and try to keep it from becoming a self-perpetuating downturn to avoid either a recession or a deep recession. If you're starting to anticipate the Fed's going to be cutting because of the tax hike, because the consumption tax effects exceed any other effects. When economists do tariff analysis, they usually assume fiscal neutrality. It was just an assumption to focus on the efficiency effects of the tariff, the trade action. But as of now, this is not fiscally neutral. It's a tax hike, and a fiscal consolidation is dollar negative. And we've got some positive reactions from Europe. They've been, hey, we're seeing less demand for the U.S. We anticipate less demand from the U.S. We can't count on U.S. military protection. We're spending more. And that is Euro positive. So I think until we're in a different fiscal equilibrium, which could happen if the fiscal policy evolves, I think for now, the right way to think of this is a fiscal consolidation, a reduction in the attractiveness of U.S. financial assets, and therefore a dollar negative shock. The unknown thing here is we've really whacked China with the prohibitive tariffs on China. And so far, China hasn't let its currency move. And China's currency is managed. It's a choice. If the Chinese choose to retaliate by letting their currency go, that would change the dynamics a bit vis-a-vis a lot of Asia, but it probably wouldn't change the dynamics vis-a-vis Europe.
You bring up China and the strikingly high rates that are now going to be in place on China. If you just look at the way the tariffs yesterday are stacked on top of the 20% that Trump had already imposed, plus up to 25% that he had imposed during his first term, you're kind of looking at mid-50s to 80 or more on percentage tariffs on many U.S. imports from China. Again, positing no deal, and then I want to come to talk about deals with you, Brad. Again, positing no deal, what do you think happens to the U.S.-China trading relationship?
So let's set the baseline. Right now, using the U.S. data, imports about $430 billion from China, right at 1.5% of GDP. So it's down, but it's not zero. In addition, there's all the de minimis imports, the small value shipments, which are mostly from China and they aren't counted. So real trade with China is probably over $500 billion on the import side. So it's not small, right? Not zero. So somewhere between 1.5% and 2% of US GDP. The increase in tariffs from the fentanyl tariffs, which are stacked on top of the so-called reciprocal tariffs for China. So that's what you get, like a 50% tariff on, let's say, $500 billion of trade. The just pay cost is $250 billion. That's a lot of money. Over time, we can be almost certain that bilateral trade between the U.S. and China will go to zero. A 50% tariff should be prohibitive. The elasticity is 2, so you would expect over time 100% reduction in trade. So essentially no trade. We'll get Chinese parts through third parties. It'll be a little bit misleading, but the tariffs are set at levels that are designed to block trade, to decouple in a narrow sense or formal sense. And China's going to retaliate. They'll not buy U.S. soybeans. They'll not buy Boeings. It'll take time, but U.S. trade with China will shrink on the other way. Over time, you have this decoupling. But in the near term, look, a lot of these goods were already tariffed at some levels where people knew that there was a risk of tariff and they were still buying the part or the component or the final good from China. Apple had not completely moved away from China. They moved to India where they faced a 25% tariff, so they'd probably move more there. But it takes time. And so I think in the short run, an awful lot of people are just going to be paying these exorbitant tariffs.
You brought up, Brad, the prospect of Chinese retaliation. And I think one of the things we are seeing out of foreign capitals, both prior to yesterday, in advance of yesterday, and then over the last 24 hours, is clear signals by a whole range of foreign capitals that they plan to retaliate, but also, for many of them, that threaten retaliation, but also still hoping to get a deal via negotiations. What do you think is, A, the retaliation we should be looking for from a couple of our big trading partners, whether it's European Union or China? And then what do you think the potential deal space here is? Do you think it's realistic that we're going to see a bunch of deals in the coming couple of months?
Look, ultimately, it depends on what the president wants. We know Bessent wants deals. We know Hassett wants deals. Very senior advisors of the president are hoping for deals. The president and some of his other advisors have been much more reluctant. If you really want to bring the bilateral deficit down, you can't do too many deals. A 10% tariff on everyone wouldn't get rid of all bilateral deficits. Just wouldn't.
10% just strikes me as a pay it tariff. That is a good rate revenue raising, because most imports, we'd still import and we'd just pay the tariff.
So it's a good revenue raiser. It's relatively simple to administer. So you're 100% agree. I mean, I mostly agree with you, as you know. I think the retaliation options for China and for Europe and Canada, let's just pick them as examples, differ a little bit, and the deal space differs a little bit. For China, we actually know their retaliation options really well. It's 2019 all over again. They've never tariffed imports of parts that feed their export machine. Those are down a bit over time relative to they were in 2019. But for the C919, their Chinese airplane still requires some American-made parts. They're not going to tariff those parts. They're certainly going to intensify efforts to make a Chinese aircraft engine will substitute away from GE engines. I mean, that they're trying, they'll do more. But for things that they need that benefit their economy, they didn't tariff them. For things which they need, but where there's an alternative source of supply, they've went to the alternative source of supply. All new aircraft orders will go to Airbus. I mean, there'll be a pretend negotiation with Boeing so Airbus can't cheat you on the price. But at the end of the day, all the orders will go to Airbus. And then for soybeans, all the orders possible will go to Brazil. And for pork and beef, where there are multiple suppliers, where the U.S. purchases are optional, or lobsters, where we compete with Canada and Australia, those are just going to be zeroed out. Not huge things, but they're just zeroed out. They're going to go heavy and hard against ag interests, because ag imports for China, other than soybeans, are optional. They're luxury items that supplement the core diet. They're not things you have to have. So we know what they're going to do, and that will have some impact. What we don't know is whether they're going to choose to add to that with a currency move, which is a unique Chinese option because they manage their currency, and whether they're going to go after Tesla or Apple's in China business. You can debate that, but those are their kind of escalatory options. And then they have the unique option, which is also part of the deal space, of basically saying, we don't care that you guys want to buy TikTok. We're just not going to let you buy TikTok. It's either let China continue to operate TikTok, Chinese company, or kill it. Nothing in between. Take the political hit with younger voters or violate the law. In any case, that's your retaliation options, and that's kind of your deal space too. And they've shown that they're willing to do deals that don't imply bringing tariffs down to zero. They've accepted some tariffs just to keep the levels reasonable. And then clearly a TikTok is part of the deal. That's the deal space. With the EU, they're going to be targeted in their retaliation. They're not going to hit LNG. They've said they're going to give a month, which is smart. The threat of retaliation is maybe more valuable than actual retaliation. And they've already, with the steel tariffs, the retaliation of steel tariffs, hit a lot of the obvious targets, the whiskey, the Harley Davidsons. If you've been in this world for a while, there's a set of products that are always on tariff list. We have them, they have them.
I've spoken over the years a couple of times to the American Distilled Spirits Council, which is the trade association for the whiskey guys. And they are just always in the crosshairs on this. And I kind of feel for them, but they're always on the list.
But at least there's a domestic market for their product. Yeah. We're not going to buy Scotch or Irish with, who knows? Definitely not Irish, but maybe we'll do a special deal with the Brits. Then for the Europe, okay, I think they have to tariff our autos. I think the Canadians have to tariff our autos just to create the space to negotiate, but also basically to force, in Europe's case, Mercedes and BMW to produce SUVs in Europe. I mean, right now, Mercedes and BMW are the big traders in both directions. SUVs go to Europe from the US. We get a lot of parts from Europe, go back, and then sedans come to the US. If the U.S. is going to basically say the sedans have to be made in the U.S., I think it's reasonable for Europe to say, okay, well, the SUVs need to be made in Europe. So we'll cost Mercedes and BMW less efficient. But if we're going to give up the gains of trade, we're going to give up the gains of trade in both directions. And then for Europe, there's the added option of going after the tech companies in some way and using the anti-coercion tool in a creative way. You probably thought about exactly what you would do. I'm not sure the exact lever, but that is part of the retaliation options. And then the deal space includes sort of similar stuff, plus LNG purchases. Plus, we could talk about my favorite, which is Pharma, where I'm out of consensus, but I've got some ideas.
I want to come to Pharma in just a second, because I am interested in your views on Pharma and how Pharma is going to fare here. Also, because the administration has signaled very, very clearly we're going to see a Pharma 232 and sort of separate pharmaceutical tariffs in the near term. You asked, had I been thinking about what Europe might do to retaliate in the kind of non-tariff way? And I've certainly read some articles out of European think tanks on this, and I think the options they seem to have are kind of go after American tech firms. There are also proposals out there to limit European investment in the United States. Sort of if the U.S. goal is to attract European companies to come and open up shop in the U.S., why don't they think about actually prohibiting that? I don't know if the commission would actually buy that. I don't know what the member state dynamics in that would be, but I think that's one of the more interesting proposals that I've seen in the kind of European thought leadership that they could use to retaliate. And then when we talk about Europe imposing services bans, a lot of our minds obviously go to digital, but they are clearly thinking about other things like closing off European deals to American banks. I do think it's going to be complicated for Europe to do this because they actually need to build member state coalitions to support it, and they have their own complicated internal politics, but they are clearly looking at it. But Pharma, I am quite interested after we have seen for almost a decade now a U.S. tax code-driven offshoring of pharmaceutical manufacturing to Europe, particularly to Ireland, but also to elsewhere in Europe that you have written quite a bit about. Now we're going to see tariffs on pharmaceutical imports. Also, even aside from the offshoring of American pharmaceutical manufacturing, Europe actually has a lot of pharmaceutical companies and makes a lot of and invents a lot of pharmaceuticals. How do you think the pharmaceutical side of this is going to play out? What do you think Europe should be thinking about there?
This is a point I've made, which is a little bit not so orthodox. But if Trump really cares about the bilateral imbalance, the biggest recent driver of the bilateral imbalance getting wider or not shrinking with the LNG exports has been pharma. And yes, there are European companies. A little bit of the European companies often comes through Switzerland for their own tax reasons. But some of the European companies have tax structures like Denmark, which makes Novo Nordisk willing to produce in the U.S. They still pay tax in Denmark. It's the U.S. companies more than anyone else who need to be in Europe to avoid U.S. tax. European companies can't avoid European tax by being in the U.S. They still have to pay back home. So there is a concentration around Ireland and Belgium, which has a very favorable IP box and a couple of big pharma companies have large operations there. And that is really contributing to the bilateral deficit. So either Trump solves that on his own with the tariff, 25% tariff on imports, functionally acts like an income tax because there's so much transfer pricing embedded in it. Now, if Trump doesn't force the companies to come home, then I think if Europe wants to change the bilateral balance, all you have to do is change transfer pricing between the U.S. and Ireland. We're close to $100 billion on the deficit with Ireland now. 3/4 of that is pharma because Eli Lilly's making their weight loss drug in Ireland and Novo's making their weight loss drug in the U.S. The deficit is going real fast, but it's mostly because of Lilly, not because of Novo. So all you have to do, if you're Europe, if you want to shrink the bilateral deficit, if that's all Trump cares about, is find a tax on transfer pricing that really hits American pharma companies so that they will still be in Ireland. They'll still hire their Irish plants to make their drugs. They just will hire them at the actual cost of production. They'll treat Ireland like Apple treats China. They won't book all their profits there. And boom, you actually get rid of a lot of the trade deficit. That highlights the absurdity of everything. The absurdity of focusing on the bilateral deficit and the absurdity of the U.S. tax structure for pharma.
That is a really interesting point, Brad, right? Because right now the incentive for an American manufacturer of pharmaceutical products in Ireland is to declare a very high value on that pharmaceutical product so that they can book the profit in Europe, whereas you could see the same volume of pharmaceutical products shipped to the United States at a much lower declared value. There goes half the trade deficit. That's actually really interesting.
It really does. I mean, it's such an easy, elegant solution. And the Irish will like it because they collect tax on that.
Well, what happens to their sovereign wealth fund if they don't have tax revenue?
I mean, they'll have to use their sovereign wealth fund as a sovereign adjustment fund.
Yeah, no,
in any case,
very fair. I know we're getting towards the end of our time here, Brad. One or two just last questions for you. So one thing I am watching is whether we finally see domestic here in the U.S. lawsuits against these tariffs. You know, I have argued in a couple of different forums, and other lawyers have been arguing in a couple of different forums, that the statute that Trump is using for these tariffs, the International Emergency Economic Powers Act, the 1977 emergency statute, just doesn't authorize tariffs. And I didn't need to get into those arguments here. I've published them elsewhere. I do think we're going to see litigation on these tariffs in the coming weeks. I think companies are holding off to see if maybe April 2nd wasn't going to be that bad, to see if deals were going to be struck. Also, I think companies don't want to be the victims of Trump retaliation if they sue, but I think the scale of these tariffs is going to prod some plaintiffs into court. I don't know where those lawsuits will come out. I think they'll be successful, but that's a high confidence prediction. A question for you, Brad. Let's suppose that there is successful litigation against these tariffs in a couple of months, and the courts are making these tariffs fall apart. What do you think the Trump administration does if they start losing cases here? Do they regroup and do this under other authorities, or do they, decide, hey, latter day in court, time to move on to something else?
Look, I think the president is 100% committed. I think Scott Bessent wouldn't mind if there was a challenge that succeeded. But the president outranks the Secretary of the Treasury. So I think they will find a way. The thing about IEEPA is you can kind of do it overnight. Not quite, but close. So,
given they were apparently debating yesterday's tariffs right up until the day before, it pretty much is overnight. Let's just be direct.
I think they knew they were going to use IEEPA, so they had the emergency set. But the level, you can, it's like a sanction. You have sanctions are mostly full discretion for the executive by design. So treating tariffs like a sanction, it lets you move real fast. So you'll be forced to use more regular order, more 232s. Supposedly they were considering doing the reciprocal tariffs, which aren't reciprocal. They're tariffs on bilateral trade deficits. So they would have to do them in a more truly reciprocal way with a bunch of 301 investigations and argue that differentials in tariff rates and differentials in non-tariff barriers are within the scope of the 301 statute, and then use the 301s to apply tariffs. Now, you wouldn't hit a Pacific island with penguins with a 301. You probably wouldn't go to for Bangladesh and Sri Lanka.
Yeah, the staff effort to do a 301 Pacific island with penguins, USTR would just say, you know what, this isn't worth it. So,
you would have to get a lawyer dedicated to 301s against the South Pacific. But you could do China, you could do the EU, you could do Japan, you could do Taiwan. You were going to hit Taiwan anyway with the CHIPS 232. So, with other statutes, it would take longer. But you could kind of maybe not end up at the exact same place, but you could find other options. They were considering, you can always do 150 days balance of payments tariffs. So you get the universal 10% that way. Now, Congress has to approve it at the end of 150 days. But then maybe you cram that through reconciliation. I think they're all in, to be honest. So it's still worth it to challenge it. The Emergency Act has just been stretched so far. And I'm being a lawyer without a law degree, but like all this stuff about original intent and so forth, the intent of the founders was that tariffs and taxes would originate in Congress. That seems pretty
I think it's very clear. You just read Article 1, Section 8, and, it's what are the authorities of Congress, and one of them is lay and collect duties, excises, et cetera, et cetera. It's very clearly in Article 1.
And the whole debate is whether you've delegated that with IEEPA and whether restrictions include tariffs, which seem to threaten Congress's taxing power. I don't know. You can argue it. I so much admire you. I want to say Peter Harrell in the Supreme Court arguing this case. I don't know if you're part of the Supreme Court VAR, but you could be.
I'm not a litigator. I would be happy to do a brief on it, but I'm not the person to figure out jurisdiction and venue and that kind of thing. But look, you've been very generous with your time, Brad, and appreciate you coming back to talk about all of this. One last question for you. I know you have some travel over the next week. I understand you're going to Europe and that kind of thing. But while you are on the road, what are you going to be watching for next steps and how this may play out? What do you think the sort of signals we should be looking for are?
Well, the biggest signal is if any country manages to do a deal relatively quickly. So that's signal one. I think signal two is how quickly are they going to move to tighten the current relatively loose regime on USMCA trade? How quickly are you going to get a move from any USMCA compliant part is tariff free to only the US content of a USMCA compliant part is tariff free? How quickly you're going to move to tighten up some of these loopholes? How quickly you move on the pharma? And then does the dollar keep sliding? Does the bond market keep rallying in the sense of interest rates coming down, meaning the market is anticipating a recession? Do equities keep selling off, or do they find a bid at a lower level? Because I think the pressure on the financial market will play some role. And the easiest de-escalation option for the administration, if they want to, if the markets are pushing them too hard or signaling that they're running too big of a risk, is to kind of do some of these deals. So those are what I'm watching. And then I think I know that Canadians know what they're going to do on the retaliation. I don't think I know that the Europeans know what they're going to do. I think they're still debating what they're going to do. So I think the debate in Europe about how far to go, we know they're going to do the obvious targets. I think they will do the autos. I think they'll throw that in. That hasn't yet been signaled. Or technically it's SUVs, but will they do anti-coercion, go after the tech companies in a way that they can turn on and off, just as leverage, not as a policy? Will they do this outward investment review against the U.S.? I mean, how far will they go to treating the U.S. as the enemy? And then on the China side, what happens with the currency? I'm not Scott Bessent. I'm just an analyst, but I do pay a lot of attention to Asian currencies.
That is for sure. Well, Brad, thank you so much for doing this. I really appreciate it. And good luck with the troubles.
So same. Good luck with your efforts to gin up some litigation.
Thanks a lot.